We are going to use Tesla's 10K to go over consolidation accounting topics. We're talking ASC 810. That is the GAAP codification that we are going to be looking at. A couple of core concepts we're going to go over. The basics of the consolidation accounting, the parent and the subsidiaries that are going to be combined. Also, we're going to look and see what rolls up into consolidated financials. And the last thing we want to look at when we're looking through the 10K is non-controlling interest. This is our first instance that the 10K, Tesla's 10K, is based on consolidated financial statements. And it's telling us to go to note 2, which is going to define the summary of significant accounting policies. This is where we're going to get the basic accounting concepts, ASC 810, related to consolidation accounting. This is another example. It says to refinance our significant consolidated indebtedness. This is an instance where it's showing we are rolling up all of our liabilities in the consolidated financial statements, because when you're producing consolidated financials, you're going to add up your assets, liabilities, revenues, expenses. You're going to eliminate the intercompany activity, but you're ultimately combining all the outstanding liabilities when you're consolidating financials. This is just acknowledging we have a consolidated balance sheet, same concept that I've just been going over, that we're rolling up all of our balance sheet items. All right, we're going to jump to 47. Another instance, so this is the opinion, the public accounting firm's opinion of the audited financials. Basically, it's a clean opinion, but within the clean opinion is another instance of where it's a consolidated balance sheet of Tesla Incorporated and its subsidiary, and they're defining it as the company. The company means the economic entity of Tesla, which is Tesla, the parent, plus all its subsidiaries. So let's jump down to a financial statement. Tesla Incorporated, consolidated balance sheet. So this, on the consolidated balance sheet, this is where they're rolling up all the assets, liabilities, not equity, but all the assets and liabilities in this situation. So when you see cash, that is Tesla Incorporated, the parent's cash, plus all the cash related to its subsidiary. Now, if you keep scrolling through here, this is our first instance of non-controlling interest in subsidiaries. So if we see non-controlling interest on the balance sheet, we know that Tesla Incorporated doesn't own every subsidiary 100% or control 100% of that sub. And we'll see that again on the income statement. Again, income statement, you're combining all your revenues, all your expenses, you're eliminating any intercompany activity. If there's any intercompany selling between those subsidiaries, you're going to eliminate those. And then here's another instance of non-controlling interest. This is backing out the portion of income that is not attributable to Tesla Incorporated, the parent's ownership or control of certain subsidiaries, and you're backing out that income that someone else owns. On the balance sheet, same concept, flipping back up to the balance sheet. These are the net assets that Tesla Incorporated doesn't own of those subsidiaries. Same thing on other comprehensive income. Let's go skip over that quickly. And then if you look at the equity section, or they actually call it the redeemable non-controlling interest equity section, you see all the adjustments related to all those entities where they do not control or own 100%. This is just the equity section of non-controlling interest. And you can see, okay, as of December 31st, 2023, it's $733 million. So you can go all the way back up. You can tie it back into the balance sheet right there. That is our basic financial statements and areas of non-controlling interest. And if you look in the cash flow, there's also pieces related to non-controlling interest. These are portions that have been consolidated but are being backed out from the cash flow statement because that cash aspect of this isn't controlled or owned by Tesla Incorporated. Let's go to that note that defines significant accounting policies. If you've gotten some value out of the video so far, please consider smashing that like button. And if this is topics that interest you, please consider subscribing as well. All right, let's continue. The principles of consolidation accounting. This is going to be defining AS 810. And an area that they're going to really dive in hard on is the VIEs, the variable interest entities. This is where, from a ownership standpoint, it does not look like you would consolidate that particular entity. But if you look at the arrangement, if you look at the contracts, the profit sharing, Tesla Incorporated controls that entity. And because it controls the entity, it's going to consolidate the entity into their results. They actually define a variable interest entity pretty well in this. We consolidate any variable interest entities, VIE, of which we are the primary beneficiary. We have formed VIEs with financing fund investors in the ordinary course of business in order to facilitate the funding and monetization of certain attributes associated with solar energy systems and leases under direct vehicle leasing programs. Basically, these entities are controlled by Tesla Incorporated and will be consolidated into the overall results. I do want to point out the last sentence in here. All intercompany transactions and balances have been eliminated upon consolidation. That is a core concept related to consolidation accounting because you want to eliminate the intercompany payables, receivables, sales, expenses, etc. Anything that is happening intercompany, so you're not double counting transactions. I have a whole video related to eliminating intercompany transactions during the consolidation process. I will link that in the description if you want to look at that to get a better understanding of what exactly that means. Page 62. This is where we get a greater explanation of what non-controlling interest and redeemable non-controlling interest has. So it looks like a lot of the non-controlling interest and variable interest entities relates to these solar entities that are being set up either for financing. I don't fully understand exactly what they're set up for, but that seems to be the big part of the VIEs and non-controlling interest. And you'll even come across a very unique valuation methodology in here for non-controlling interest. You'll see we have further determined that the methodology for calculating the non-controlling interest and redeemable non-controlling interest balance that reflects the substantive profit sharing arrangement. So profit sharing, that is one area in a contract that can lead to consolidation of an entity, even though it might not look like you have the ownership in that entity. Profit sharing arrangement is a balance sheet approach using hypothetical liquidation at book value, HLBV method. That is a very specific valuation methodology. Looks like it's primarily related to solar type of businesses. I don't understand it. I'm not going to go into great detail, but they're acknowledging that is the valuation methodology that they're using to determine what the non-controlling interest is related to the consolidated financial statements. All right, we're going to go to page 62. This is actually going over business combinations. This is when you purchase a business and then you ultimately consolidate it into your financial statements. They're just acknowledging when they do acquisitions, they begin consolidating those acquisitions, those entities at the date of the acquisition. That is a pretty straightforward statement. Basically, when these deals get done, there's contracts that could be thousands of pages, but the acquisition date, that's a key date within the contract that determines when this entity is owned by Tesla Incorporated in this situation. And the date of the acquisition date, that's when you roll in all the results related to that acquisition into your consolidated financial statements. So page 90, note 16, this is going into greater detail of the variable interest entities that are being consolidated on Tesla Incorporated's financial statements. It looks like they have these solar VIEs, these solar entities that are set up where Tesla Incorporated is the primary beneficiary. So from a legal entity standpoint, if you looked at straight ownership, you probably wouldn't think these would be consolidated. But because the way that the contracts are structured, and it looks like it's the profit sharing in particular, that these entities, even though they're set up for financing related to solar, since Tesla Incorporated has been determined the primary beneficiary, they're being consolidated into Tesla Incorporated's financial statements. I've never worked at a big company, so when I see how many entities get consolidated into these financial statements, it's amazing. Look at all the subsidiaries of Tesla Incorporated. I have not counted these, but we're going on 1, 2, 3, 4, 5, 6, 7, 8 and change pages of subsidiaries that are being consolidated into Tesla Incorporated's financial statements. So Tesla Incorporated's 10K has a lot of consolidation accounting concepts in it. I hope this helped you understand consolidation accounting. Have a good rest of the day. Take care. And I hope to see you in the next video.